There's also a schedule in the statistical section for pledged revenue. That's a debt that is secured by a particular revenue source, and that might be, a tax-backed debt that's something that's secured by a particular tax revenue, or as is more often the case, BTA type debt, revenue-backed debt, like in this case, water bonds. Uh, but you can see there's also some special assessment debt here and some sales tax increment bonds. So this debt is secured by future growth in sales tax revenues. The purpose of this schedule is to provide some coverage ratios, debt service coverage ratios like those that we have looked at earlier in the course. They're required to show the principal and interest payments over the last 10 years and compare that with the revenue collected on the revenue source that secures that debt. Now, if it's something like a water revenue bond where those revenues are also going to pay for operating costs, then what you will see is they'll show the total revenue. So here are the water charges, less the operating expenses. And so here's the net available revenue, what's left over of that revenue source after removing the operating expenses. And then the ratio, the coverage ratio, is calculated by dividing the debt service, the principal and the interest, by the amount of net available revenue. So add these two amounts together and divide them by the net available revenue, and that gives you a coverage ratio. And as you know, coverage is giving you a sense of the sufficiency of the resource flows to repay the debt service payments in each of those years. 7 plus, fairly healthy. You look at these sales tax increment bonds, and their coverage has actually been growing over time. So what started out at 1.81 now is up at 4. That's a significant improvement. But look at these special assessment bonds here. They're never very far above 1, and in some years they're below. Now, in this case, having them be close to 1 is not necessarily a problem because that special assessment has been issued just to repay this debt. So you want it to be, just about 1 because you don't want to be assessing the payers of this special assessment more than you need in order to repay the debt. But you want it to be at least 1. And in these years, what they collected in the special assessment was not sufficient to pay the debt service, which means that the remainder had to be paid out of the general resources of the government. And that's kind of counter to what you expect a special assessment to do, which is to pay for itself. It shouldn't have to rely upon the general resources of the government unless that's the way it's set up. Usually not. If they're doing special assessments, the intention is for that special assessment to cover the cost of the bonds. These are 3 of the most common debt ratios. We've already talked about the first 2 earlier in the course, times interest earned and debt service coverage. Another one of the most common ones is to look at debt service as a percentage of expenditures to give you a sense of the magnitude or the amount of the government's spending that is related to repaying debt and therefore is not going toward providing services directly. Times interest earned, as you know, cash flow from operations plus the interest expense divided by interest expense. So looking at the enterprise funds financial statements, this is the cash flow statement for the enterprise funds. Here's your cash provided by operating activities for its 2 business type activities, water and sewer and parking facilities. So let's analyze. When you do this analysis, though, let me stop for a second. Generally, there isn't any fungibility of the resources of the business type activities. What I mean by that is the resources related to water and sewer usually can only be used for water and sewer, and the resources related to parking facilities can only be used for parking facilities. So when you're calculating these ratios, you want to do them for each business type activity, not for the business type activities as a whole, because looking at them as a whole isn't really meaningful. They are not; those resources are not available to cover other business type activities. They're only available for each of the business type activities that generates them. So that was your cash flow from operations. Here's your interest expense. Let me make a point of saying, when you look at the income statement here, or the statement of revenues, expenses, and changes in fund net position, after seeing the operating revenues and the operating expenses, there's one section that shows non-operating revenues and expenses, and in order to distinguish expenses from revenues, the expenses are put in parentheses here, as opposed to the positive numbers that represent non-operating revenues. But when you put these in your ratios, get rid of those parentheses. Treat it as a positive number. I have seen some ratios accidentally calculated treating those as negative numbers, and of course the ratio comes out wrong. So back to that ratio, cash flow from operations plus interest expense divided by interest expense. Here are the numbers for water and sewer, and they have a coverage ratio of 2%, 2.06, meaning roughly double what is needed to repay the debt, to repay the interest, sorry. Compared with what we calculated for Orange County, which was something like 40 on their business type activities, 2 doesn't seem as healthy, but it may very well be that we're looking at an activity that has very significant non-operating revenues. Maybe they're getting a large subsidy or grant from another government. Everything needs to be looked at in context. Here's the ratio then for the parking facilities, and that's 1.2. So their operating revenues are really just barely enough to make their debt service payments, let alone support the operations of that business type activity. Debt service coverage is then adding the repayment of principal to the equation as well. So we're not just looking at interest, we're also looking at principal repayments. So cash flows from operations plus debt service, or alternatively cash flow from operations plus interest plus principal divided by interest plus principal or debt service. For the water and sewer activity, these are the numbers. Here's your cash flow from operations. This is the interest that we saw, and here's the principal repayment. Well, this is an error. I'm just noticing in the slide. Sorry about that. So you might want to look, double check this calculation to make sure it's right. It comes out to 1.3, but perhaps I calculated that using this 4,108,000 rather than the 3,108,000. At any rate, you expect that the debt service coverage ratio is going to be lower than the interest coverage ratio because you're also including the principal repayment. And then here it is for the parking facilities, and you can see it's even closer to just being barely sufficient to cover those debt service payments. Debt service as a percentage of expenditures is looking at, as I mentioned, the portion of the resources of the government that are consumed with repaying debt. In the statistical section, in the schedule of changes in fund balance, looking at the governmental funds, governments are required to present a ratio that shows debt service as a percentage of non-capital expenditures. So not total expenditures, but total expenditures less the capital expenditures in each of those years. And you can see this is a really high ratio. If I saw a government that had debt service as a percentage of non-capital expenditures this high, I'd be a little alarmed. And look at the fact that it was almost 35%. That is really, really high. Um, I'd be very concerned about that. Now, if it's just 1 year, it may be because of something like this, where they have a refunding that might have increased the debt service payments in any particular year. Um, but if you look at this government, you can see that yeah, they had here's 1 year where they had a pretty significant bump in their sorry in their total, but the debt service was growing pretty rapidly as well. Their interest payment in that year was 14 million, but it goes down pretty significantly in the next year, and then starts to rise to just about that same level by the end of the year, by the end of the 10-year period. Still, at that end of the 10-year period, more than $1 out of $5 that this government spends is going to repay its outstanding debt, and that's really alarming. That's quite high. Looking specifically at how financial analysts, municipal analysts in the municipal bond industry look at general obligation and tax-backed debt, there are basically four things that they're analyzing. The amount of debt outstanding. I'm looking particularly at geo credit analysis here, but it would be the same for tax-backed debt as well. An analysis of the budgetary operations of the government, how it raises its resources and what it spends them on. An analysis of the revenue structure. So looking at the revenue, this is going to be just like the revenue analysis we looked at a couple of units ago, but focusing specifically on the revenues that are used to repay the debt. So for GEO, you're going to look at the total revenue package, at least the total general revenue package. If you're looking at tax-backed debt, you're going to be looking specifically at the tax revenue that is used to secure that debt. And then lastly, an analysis of the economy. So looking at each of those a little bit more closely, analyzing the amount of debt outstanding is the kind of stuff that we've been looking at up to this point. Those debt ratios are the kinds of ratios that credit analysts are going to use to analyze the outstanding debt. What's the size of the burden? How much debt is going to be repaid with those revenues that you're looking at. In the case of GO, you're looking at general revenues as a whole. They're going to look at overlapping debt. They're going to look at the unfunded liabilities related to pensions and OPEB, and we'll talk a little bit more about those in the next unit. But they generally don't calculate their debt ratios, including those unfunded liabilities, because they're not shown on the face of the financial statements. But it's context. You understand that this is another significant obligation that this government has. In a lot of cases, it may be considerably bigger than the amount of outstanding debt they have, and they're going to have to provide resources to that pension or OPEB plan eventually, and that competes in the minds of the credit analyst with the repayment of debt. The government has scarce resources, and what choice is it going to make? What choice is it allowed to make if it's forced to choose between making pension contributions on the one hand or repaying its debt on the other? As we talked about, they're going to look at debt limitations. So not only their capacity or their affordability of their debt, but also their legal authority to issue debt. In terms of analysis of budgetary operations, they're going to look at how the government is structured. Is it a strong executive government, like a state, like a city with a strong or separately elected mayor, or is it a council manager type of government where you have a city council and it hires a professional manager for the government? A lot of small cities, even some large cities, are city manager and city council type of governments. You want to know how much power does the chief executive or the legislative body have over the budgetary process, and in terms of deciding what they're going to spend on and how much money they're going to raise. You're going to look at what they've been spending on over time. How fast has that grown? You're going to look at whether they're using short-term debt in order to smooth out their cash flows, and has their use of short-term debt grown over time. If it's grown in comparison with their financial activity, meaning they're borrowing a larger percentage of their cash flow every year, that's something that might alarm a financial analyst. And in this case, to get that kind of context, what they'll use a lot of the time is the amount of outstanding short-term debt divided by the general fund revenues of the prior year, or maybe they'll look at the amount of short-term debt, the total amount issued in the prior year divided by general fund revenues, or whatever revenue source those debts or those notes are being repaid from. And you can get those amounts issued by looking at the note disclosure for short-term debt, which will show you how much, if any, was outstanding at the beginning of the year, how much was issued during the year, how much was repaid, and then how much was still outstanding as of the end of the year. In addition to the more quantitative analyses, they're also going to look at something that's a little bit more qualitative, and that is citizen attitudes toward debt. This is particularly important in areas where debt issuance requires approval of the citizenry. When they go to vote for their school board members, they're also going to vote on a referendum from the school district to issue some debt for a particular purpose, and that debt can only be authorized if a majority of the voters vote yes. And so analysts will look at trends in those voting practices over time. So are these citizens likely to support a new debt issuance? And that's important because they may have all the capacity to issue debt in the world. They can, their debt burden is very low when compared to property values or per capita. But if there's no evidence that citizens are going to support issuing more debt because they've voted down every referendum for the last 20 years, then it doesn't matter how much financial capacity they have to issue that debt. They're not going to be able to issue it as a practical matter because the citizens are never going to approve it. In terms of analysis of revenue structure, this is going to look a lot like what we were talking about in the unit on revenue analysis. They're going to look at where the revenue comes from and how that has changed over time, and they're going to look at the relevant parts of the economy, both as a part of the revenue analysis and this fourth area where they're looking at the health of the economy that the government is located in, because that's going to affect their ability to raise general revenues. And you're going to see the very basic kinds of things that you would expect. What's going on with property values, whether they have a large employer or several large employers who are dominant, or if the employment base is more broadly diversified. What's going on with the population? How old is it? How much is it growing or declining? Employment and unemployment numbers, and then other indicators that might raise red flags or concerns about the health of the economy of that government. These are some of the common ratios that are calculated when doing geo-credit analysis. These are the kinds of things that we've already talked about: debt per capita, debt as a percentage of market value of property, debt as a percentage of personal income, and those will be calculated, both just the direct debt, the outstanding geo debt, and sometimes then the geo debt plus the overlapping debt. And then there's this thing called minimum debt service requirements, which we'll spend a little time looking at right now. This is the required note disclosure on minimum debt service requirements. Governments are required to show each of the next 5 fiscal years individually, and then the remainder of the maturity of the debt in 5-year increments thereafter until the debt is completely retired. They are required to show principal separate from interest, and they're required to show each type of debt separately. So you see the geo debt separately from the water and sewer and the parking debt for this particular government. Actually, let me go back for a second to look at that schedule. Sorry about that. We'll look at some, when we look at revenue analysis in a second, revenue debt analysis. Essentially what you're looking at here is you're going to be looking for bubbles. Is there is the growth or the change in principal and interest smooth and predictable, or are there some balloon payments out there somewhere that are looming and that might not be able to be handled with the normal annual inflows of resources that governmental entity has at its disposal? And you're going to look at some ratios that will compare the largest debt service payments in the future with their capacity to repay it, with their revenue, their resource inflows. And we'll look at those ratios a little bit in a few slides. Very briefly, let me just set the context for revenue debt analysis as it's conducted by the municipal bond community. We will get into this a lot more in a future unit looking at business type activity analysis. But the factors that are looked at by the municipal bond community when they're analyzing revenue debt are not exactly the same as they are for general obligation or tax-backed debt. Because when you're looking at those, you're looking at sort of the general financial health of the government, because that debt is repaid out of tax revenues or general revenues of the government. But when you're looking at revenue debt, the only thing they're really concerned about, or the thing they're primarily concerned about anyway, is that revenue source that is securing the debt. So the overall health of the government is an issue, but not as important an issue as that very specific revenue source and how healthy it's going to be going forward. So one of the things they're going to look at is the basic security. What revenue has been pledged to repay the debt? Are there any limits on the raising of that revenue? What's happened with it over time? Is it growing? Is it declining? And how does it compare with the need to repay debt? How much their principal and interest payments are going to be? They want to look at the flow of funds. In other words, there are a variety of things that this entity spends money on, not just repaying debt. And what are the priorities there? Does it repay debt first, or is debt just one of many things that are paid as they come up, and there's no order of priority, there's no seniority, or are there other other debts outstanding that might take precedence in terms of drawing on that same revenue source? A lot of this involves looking at the documentation, the legal documentation of the debt issuance, and getting a sense of legally where the bondholder stands, and that's priority of claims. If there are a variety of creditors who have a claim to that revenue source, where does the bondholder stand? Are they first? Are they second? Are they last? That will affect how much a government will have to pay in terms of interest and interest rate to potential buyers of that debt. If it's all of the things being equal, if that the priority is that the debt repayment gets first dibs on that revenue source, that's going to be cheaper debt for a government than in a situation where it's third or fourth or fifth in line. And then lastly, they're going to analyze the revenue, and this is going to look a lot like the revenue analysis that we looked at a couple of weeks ago. They're going to look at coverage, both what is required by the debt instrument, and in most cases with revenue debt, the legal documentation requires the government that issues the debt to meet a certain coverage ratio every year. meaning it's going to have to raise sufficient revenue in order to achieve that coverage ratio. And if it doesn't achieve it, it is technically in default on that debt, and the bondholders can demand repayment immediately in a lot of cases. Generally, that doesn't happen, so it's referred to as a technical default. It didn't meet one of the criteria that are included in the documentation of the debt issuance, but it still made the payments. So it didn't reach its coverage ratio of 4. Let's say that's what the debt instrument required. They were at 3.8. So technically they were in default, but they still made the payments without any problem in that year, so they didn't actually go into default. So they're going to look at what's required, they're going to look at what the actual ratios were and compare them. They're going to look at the rates that are being charged that produce that revenue, the base that the charges are being applied to. So the rates might be, a certain cost per 100 gallons of water consumed. The base is going to be water consumption. They're going to look at demand for service and competition. That's going to affect how much revenue they're generating. Is demand going up? Are people consuming more water? Is there another water utility that is a competitor? Generally, for water, there isn't. But if we're looking at a hospital or an airport, a parking facility, a golf course, those are things that have competitors both from other governments and from the private and not-for-profit sector. Hospitals, colleges, and universities. There aren't just public universities out there. There are also private, not-for-profit universities that are direct competitors for the same customers that the charges of that entity, in this case a public university, is applying those charges to. And then an analysis of the economy, of the demographics of the area, to the extent that those factors can affect the raising of that particular revenue. And then looking at this thing called an additional bonds test, which is an analysis we won't get into in any detail in this course because it's more akin to looking at municipal finance and municipal credit analysis in particular. But essentially what they're trying to get a sense of is can this government issue more debt that is going to be repaid with the same revenue source that is securing the debt that you're considering buying? Because that would mean there'd be more competition for those same limited resources. And the more possibility that the government can issue more debt repaid with that same revenue source, the more concern a municipal analyst might have about the creditworthiness of that government, its ability to repay that particular bond issue. I mentioned this a little bit earlier, maximum annual debt service. What they're looking at here then is the largest annual debt service payment in that schedule of future minimum debt service payments. So in the numerator, you're going to see net income plus depreciation plus interest expense, and in the denominator, that maximum annual debt service amount. So looking at the statement of revenues, expenses, and changes in fund net position for the business type activities or enterprise funds, here is your net income. We'll look just at the water and sewer. It's a little bit more complicated looking at parking facilities because they had a net loss. But water and sewer had net income of $4.4 million. Here's the depreciation, which you're adding back in because it's a non-cash expense. And there's your interest expense. Again, I remind you, take those parentheses off and treat it as a positive number. That's what you do with those expenses. If you were looking at the operating loss here, that's a negative number. The expenses were greater than the revenues, and in the ratio, that ought to be treated that way. But that's a different thing than these expenses down here, which are just shown in this form to distinguish them from the revenues. So you want to, for these expenses, you always want to use the expenses as positive numbers. There are no negative expenses, there are only positive expenses. And then you're going to look for the maximum annual debt service here, which for the water and sewer happens to be in 2015. You add those two together, and those go into the denominator of the ratio. There are the numbers right there. Here's your net income, the depreciation added back, the interest expense, and then the principal and interest from the year in which it's highest. And that number is 0.88. So at least what they've got in terms of net income right now wouldn't be sufficient to cover that. But, you know, as is often the case, you know, at least in the short term, looking out, there's, you know, those expenses are going to, the debt service repayment is going to be higher than it is right now. They tend to grow over time. And so you wouldn't necessarily expect it to be over 1. But I think you want it to be close, because you don't want to think that they're going to have some kind of extraordinary increase in revenue in order to be able to afford those debt service payments. You might, instead of looking at maximum annual debt service, look at average debt service. So instead of looking for the largest year, you're going to take a number of years and find an average annual debt service payment for that period and put that in the denominator of the ratio instead of maximum annual debt service. So let's say you look at the next 5 years. So to get an average, you're going to add all of these up and divide by the number of years, which in this case is 5, and that will give you the average debt service payment for those years, which comes out to $7,376,400, and you would expect that that number would look a little bit better because it's an average of all those years rather than picking out the single largest year in the future. And with that, we're done with our very brief look at revenue bond analysis, which we'll get into a lot more when we look at BTAs and analysis of BTAs. But that also wraps up the general discussion of debt analysis. What are your takeaways here? Debt certainly is the largest of the liabilities, the largest of the financial obligations that is shown on the face of the financial statements right now. It may not be as big an obligation as unfunded pension or OPEB obligations, but those, at least at this point, aren't shown on the face of the financial statement. They're still important. We're going to talk about those in the next unit, and they're important as context for understanding that debt limit, because even though it's not on the face of the financial statements right now, it will be based on new statements GASB just issued in June. So in a couple of years, you'll see those on the face of the financial statement as well. But even though they're in the notes rather than the face of the financial statements, there's still an obligation that competes for the scarce resources of the government with the repayment of debt. And so if your concern is specifically about whether the government can repay debt because you work for a bond rating agency, then you're going to want to look at that debt in the context of those other obligations. And of course, there are long-term liabilities apart from outstanding debt and pension and OPEB unfunded liabilities. There are claims and judgments and compensated absences, which are accumulated leave that has not been used and for which employees are compensated when they retire or otherwise leave the employment of the government. Those tend to accumulate over time, and like debt service, every year the government is going to have to pay a certain amount of that out when its employees retire or leave for employment somewhere else. Pollution remediation obligations can be another big thing. That's a government's obligation to clean up pollution. GASB statements require them to calculate that amount and to recognize it as a liability in the financial statement. So there are other liabilities that may draw on the resources of the government as well, and those need to be considered as also in addition to looking at debt and looking at retirement obligations. They need to be looking at these other long-term liabilities as well. Thank you.